Stock market is on the verge of breaking new record highs, and the question on everybody's mind is, should I be buying stocks now? And to really answer the question, there are four things you want to pay attention to. Number one, inflation. Number two, tariffs. Number three, the economy. And number four, history. And let's break this down one by one, starting with number one, inflation. We just got the latest inflation report, which said inflation came in at around 2.4%, which for a lot of people was better than expected. And this doesn't mean that the prices of things are falling. This means that the prices of things are rising less fast than they were before. But more specifically, let's take a look at where we are seeing the highest inflation and where we are seeing the negative inflation. Starting with the high inflation. The highest place where we're seeing inflation still is auto insurance prices. Number two is energy, specifically for households. Number three are housing costs. And number four are restaurant costs. The top three places where we're seeing negative inflation are number one, gas prices, number two, airfare prices, and number three, electronics prices, according to the data. Now again, this does not mean that the prices of things are falling. The lower inflation rate means that the prices of things are rising less fast. And the reason why a lot of people get this confused and why I want to emphasize this is because the inflation that we're seeing today in 2025 is on top of the 2024 inflation, is on top of the 2023 inflation, is on top of the 2022 inflation, and is on top of the 2021 inflation. And over the last 5 years, what we've seen happen is that the average salary in America has gone up by around 20%, while the average inflation rate has gone up by around 23 to 24%, which means that the average American is earning more money, but it hasn't grown fast enough to keep up with inflation. And the reason why you want to pay attention to inflation is because there's a lot of headlines talking about how inflation is cooling. This is good news. But remember, the Federal Reserve Bank wants to see 2% inflation. We're not there yet. We're very close. But even 2% inflation doesn't make up for all the inflation that we've seen for the last number of years. Which brings me to the second point that I want to talk about, which has to do with tariffs. Because the United States and China has been meeting to hopefully come to an agreement when it comes to tariffs. And what we know right now is that President Trump says that the deal is, quote, done. We're just waiting for a sign-off from China and the United States, but we'll ultimately see what happens. In addition to that, the Treasury Secretary, Scott Bessent, told Congress that it is, quote, highly likely that we will see an additional tariff pause, assuming that countries are agreeing in, quote, good faith to come to a tariff agreement. What does that mean? Well, on July 8th, we are expected to get the next piece of information, data, when it comes to tariffs. A lot of people are holding their breath because they don't want to see high tariffs. We don't know what's going to happen. And what we've seen in the past is that tariff news causes a lot of volatility in the markets. And now we have the Treasury Secretary kind of hinting that if we don't have an agreement, we could potentially extend the tariff pause again. Again, President Trump has not said that. This is the Treasury Secretary. Just keep that in mind, because if there is more tariffs than expected, that could potentially hurt the economy, which could impact the stock market. This brings me to number three, understanding what's going on in the economy. Yes, we cover all of this in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get my investing masterclass as a bonus just for joining, where you'll be able to learn how you can start investing and find hidden investment opportunities before everybody else. So if you want to get Market Briefs plus the investing masterclass, all you have to do is click the link down in the description below. Now, the economy is an interesting one because the most recent unemployment report says that unemployment in America is low at 4.2%. But then when you talk to many people about the job market, a lot of people are saying, quote, that the job market is trash. And I'm quoting Yahoo Finance from this. But the whole idea is the unemployment numbers, the data say that the job market is strong, but part of the reason for that is some people are underemployed, meaning they're working jobs that they're overqualified for, or they're working multiple jobs to make up for it, making the data look a little bit better. But in addition to that, you also want to take a look at debt levels, because credit card debt in America is breaking new all-time highs pretty much every month. And the reason why this matters is because there's a dual side coin to this. On one end, the economy says this is great. Americans are spending money. Americans keep spending money no matter what. On the flip side, Americans are going deeper and deeper and deeper into debt, and you have to think that there's eventually going to be a breaking point. Because our economy, our economic system runs on spending. The more money you spend, the more money somebody else makes. And our economic system doesn't care if you spend money in your bank account. It doesn't care if you spend money on your Amex or Visa. All it cares is that you spend money. In fact, our economic system actually prefers it when you spend based off of debt. Because when you spend the $100 in your bank account, the most you can spend is $100. But if you spend the $100 in your bank account, plus the $100 that Amex is willing to lend you, well, now you've spent $200 into the economy. You've doubled your contribution to our economic system. Businesses are making twice as much money, and Amex is also making money on interest. So in the economic system, it is good for consumers to spend money they don't have, because now not only do you contribute more to our economy, but now the banks, the credit card companies are also making more money as well. Now, this doesn't mean it's your patriotic duty to go into debt to stimulate the economy. This means you got to understand how the economy works, because when you look at a company, a stock, an investment, these are things that they look at. They want to see, are Americans still spending money? And by spending money, it doesn't mean having money to spend. It means having the ability to spend, even if that ability was through debt. So based off the data, Americans are still spending money like crazy, even though debt levels are breaking new record highs. But you'd have to imagine that eventually we'll reach a breaking point, but we are not there yet. And this brings me to the most important thing that you want to understand. Number 4, history. Because if we're hitting a potential peak in the stock market, which nobody knows, again, I want to make sure that this is clear. Nobody knows when we're going to see a stock market crash. Nobody knows when we're going to see a recession. We know that the stock market will crash. We know that a recession will happen. Nobody knows when. But let's go back in time a little bit. Let's imagine that you bought at the peak before the 2020 pandemic, before the 2020 stock market crash. Markets are all-time highs, then markets crash at the fastest rate we've ever seen. Well, if you didn't sell and you were holding on to broad economic ETFs, you're holding on to good investments, you are making more money today than you were before. Your investments have gone up despite the crash. Let's go back a little bit more. If you bought right before the 2008 great financial crisis, right before the markets tanked at the worst rate that we have seen since the Great Depression, well, you would still be more profitable today, assuming you held on through the crash. If we go back to the 2000 dot-com bubble bursting, where stocks, the internet industry was hammered, if you owned good investments, you would have seen markets fall, but you'd still be up today. Why do I say this? Because nobody knows when markets are going to crash. Nobody knows when things are going to go down. A lot of people are in the industry of trying to time the market because they can sell you programs on this, but nobody really knows. And instead of trying to time the market, what I'd rather you do is understand what Warren Buffett says. Time in the market beats time in the market. And the reason why he says that is if you have good investments for the long term, like if you're investing for 10 years plus, it doesn't matter what's happening in the markets, you just got to keep buying. I call it ABB, always be buying. Now, that doesn't mean that you just blindly dump your money into the markets. You got to know your strategy. I mean, I talk about 2 different investing strategies, passive investing versus active investing. Passive investing is you're just dollar cost averaging into a broad ETF or index fund. This is something like investing your money into the S&P 500, or maybe you want to get a little bit more niche into niche ETFs. But the whole idea is you are consistently, passively, and automatically investing your money into these funds every week, or every 2 weeks, or every month. And you do this whether markets are up, whether markets are down. It does not matter. You're always buying. ABB, always be buying. And you just set it and forget it. The key is you don't change it when markets go up, and you don't change it when markets go down. When markets crash, in fact, the only time you might change it is you might buy a little bit more when markets are down. That's the key. That's how you win for the long term as a passive investor. As an active investor, I'm not talking about trading. I'm talking about looking for where markets are shifting, looking for new investment opportunities based off of changes in the economy. For example, if President Trump passes an executive order on drones and drone companies could potentially make more money, that is a potential market shift. If President Trump passes an executive order to fund more space exploration, that's a potential shift in spending, which could create new potential investment opportunities. Both of these are true stories. We cover things like this in Market Briefs Pro, which is our Briefs Pro product, which if that's something you're interested in, you can also check out. But the whole idea here is you want to understand the psychology of investing, because a lot of people assume that just because markets are going up, I should not buy because buy low, sell high. Now, yes, when markets are low, there's more opportunities. But nobody knows when a peak will happen. Nobody knows when markets are going to crash. Markets could go up tomorrow, they could crash tomorrow. You need a system that will allow you to win no matter what. And 2025, I love talking about the 2025 stock market because this is one of the most educational years in the stock market. We saw 3 stock market crashes in 1 year. I don't know the last time we've ever seen that happen, if it's ever happened before. In February 2025, President Trump first announced tariffs. We all remember that. Markets crashed and people freaked out and panicked that tariffs are going to destroy the economy. Well, right after that, President Trump announced a pause on tariffs. Markets rallied back up. In March, President Trump announced even more severe tariffs, and markets globally now crashed. People were panicking for days. Markets were falling. And then he put a pause on those tariffs again. Then came April, Liberation Day. President Trump announced even bigger tariffs. Global markets sell off everywhere. We enter a bear market. I mean, it was crazy. Everyone's freaking out. But again, after there was a pause, markets rallied again. Each one of those things, each one of those crashes created an amazing buying opportunity for people that were focused on opportunity as opposed to emotion. Now, again, I don't know what's going to happen tomorrow or the rest of the year. I don't know what's going to happen with tariffs. I don't know if we're going to see a recession tomorrow. I don't know if markets are going to crash tomorrow. But what I do know for me, and make sure you understand, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. And in fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. I don't know what's going to happen tomorrow or the rest of the year or next year. But what I do know is I plan on being invested for many more years, in fact, decades. So I'm going to keep buying. And if markets do crash, I'm going to buy even more. Take that for what it's worth. But I want you to understand the game. Because what Wall Street is doing, because they're getting rich off of this, and I want you to understand what they do, is they want to know where money is moving. When markets go down, they see it as an opportunity. When they see growth, they look for where the money is moving. And that's the way I want you to think. I want you to think like an investor, not as an emotional person. And a lot of people say that they want to be investors, and then they immediately become a trader and a flipper as soon as markets go down, because then they panic and freak out. Know your strategy, invest in your education, know what type of research you need to do to find good investments, and then stick with it. Again, if you want some additional assistance, you can check out Market Briefs to stay up to date on what's happening. And you can also check out Briefs Pro to stay up to date on shifts that are happening in the markets, if that's something that you're interested in. And with that, I will see you on YouTube tomorrow.